Hello. Right, you will have read the above, so you know what's going on. So I shall read. I recommend that you open the link to the article and either read along or use the pause button to try and read and keep up and understand what I'm reading, because I'm not going to interject explanations on this one because it's going to be long enough. I'm just going to read it. Okay. Now, out of respect for Edward, I'm going to read his opening remark as well, which is the editor's note. This is a weekly post that we have decided to release outside of the paywall to give readers a better feel for the kind of macro analysis the Gold membership contains. The membership focuses on 4 themes: global macro, macro investing, the financial services industry, and the technology industry. And you can follow the link for a membership sign-up to Edward's Gold behind the paywall. Okay, here we go. Spiegel, a widely read German magazine. Edward reads German, but he probably read this one in English, has published a trilogy of articles, link above, on inflation in German that it has also translated into English. The theme is How Monetary Policy Threatens Savings. And I see this as a must-read for those interested in a German framing of the present debt crisis. This post is my extended commentary of the view expressed by Spiegel, including my own thoughts on the correct framing of the crisis and present policy solutions. And as noted, whatever Ed says, I nod through. The inflation threat people worry about. The Spiegel article represents the conventional thinking about monetary policy, government budgets and inflation within German policy circles and amongst many in the German voting populace. The crux of the problem in the German view is debt, whether that debt is private or public, and the threat people worry about from the present policy responses is currency debasement and inflation. But more than that, I believe the real threat from today's policy response is specifically an unequal distribution of inflation, with the worst impact felt by the lower and middle classes. That last point about redistribution via the uneven impact of inflation is important in terms of understanding the German view, as well as how the threat of inflation is presented in Austrian economics, a school of economics that has gained currency during the financial crisis. Let me call out a few quotes that get at this in greater detail. So we quote from the Der Spiegel article in English. Germany's central bank, the Bundesbank, has established a museum devoted to money next to its headquarters in Frankfurt. It includes displays of Brutus's coins from the Roman era to commemorate the murder of Julius Caesar, as well as 14th century Chinese yuan banknotes. There is one central message that the country's monetary watchdogs seek to convey with the exhibit. Only stable money is good money, and confidence is needed in order to create that good money. The confidence of visitors, however, is seriously shaken in the museum shop just before the exit, where for €8.95 they can buy €250,000 shredded into tiny pieces and sealed into plastic. It's meant as a gag gift, but the sight of this stack of colourful bits of currency could lead some to arrive at a simple and disturbing conclusion. A banknote is essentially nothing more than a piece of paper printed, a piece of printed paper. It has been years since Germans harboured the kind of substantial doubts about the value of their currency that they have today in the midst of the debt crisis. A poll conducted in September by Faktenkontor, a consulting company, and the market research firm Toluna, found that 1 in 4 Germans are already trying to protect his or her assets from the threat of inflation by investing in material assets, for example. Back to Edward commentating, sticks his words in. I think this leading anecdote from part 1 of the series is perfect in getting at the psychology behind worries about inflation and the value of the currency. People are waking up to the fact that fiat money has no intrinsic value. It is simply a promise to repay in kind. With the legal tender, whose value is based on the individual state's ability to tax, and the demand for the currency that comes from this taxing power and legal tender role. There is nothing tangible backing these pieces of paper. That's why the Bundesbank can shred money and hand it out as souvenirs. Ultimately, however, that leaves people a bit uneasy, because it makes plain the lack of intrinsic value at a time when many believe policy is designed to reduce the value of the currency. Ed says, here's another passage that gets at the redistribution fear. So I shall read from the Der Spiegel article. Andrew Bosomworth can offer some insights into how this form of indirect theft of assets is taking place. When Bosomworth, the head of portfolio management in Germany for PIMCO, the world's largest investment management firm, talks about the calamity that the debt crisis will bring upon mankind, he sounds like a concerned doctor. This is Bosomworth speaking. The industrialized world is struck in a severe debt and growth crisis, he warns. The central banks are fighting the disease with monetary infusions of previously unknown proportions, and the side effect is a slow but dangerous devaluation of money. Bosomworth argues that a gigantic redistribution from the bottom to the top has begun. Gradual inflation has a numbing effect. It impoverishes the lower and middle class, but they don't notice, says Bosomworth. He believes that Germans' fear of inflation is more than justified. Edward interjects. He says, this is the Austrian economics view, namely that inflation results over a period of time, and those who are able to transform their at-risk assets before inflation sets in will gain a redistributive advantage over those who cannot. In the Austrian view, it is banks and others with direct dealings with financial asset trading and government who will be in the most advantageous positions, while those on fixed incomes and invested in fixed assets will be net losers. So, traders and bankers will be switching into inflation hedges, while others geared to fixed income will be losers if and when inflation arises. So far, this is what we have seen as a result of negative real interest rates and commodity price inflation. Note here that the real economy and investment risk is not generalized inflation. Rather, it is negative real interest rates that cause losses to fixed income investments. It is commodity price inflation associated with altered portfolio preferences due to central bank government bond purchases, and it is the risk of losses related to deflating asset prices when policy support is removed. And it is the risk of losses relating to deflating asset prices when policy support is removed. Finally, there is a third quote from this article related to government money. In the eyes of PIMCO executive Bosomworth, Bernanke's approach marks a departure from the Fed's independence. We are experiencing a reverse Volcker moment in the United States, he says. What he's referring to is this. After the oil crisis of the 1970s had driven up inflation in the United States, former Fed Chairman Paul Volcker rigorously combated inflation with high interest rates. During that period, the Fed emancipated itself from the government's influence. Today, the Fed is increasingly becoming subservient to fiscal policy, Bosomworth says critically. The US government debt has just exceeded the $16 trillion threshold. Inflation could help reduce this enormous mountain of debt. The alternative is to reform and save, and to accept higher unemployment as short-term consequences, says Bosomworth. But that isn't as attractive politically. Instead, the US government is behaving the way governments have always behaved when their debts have gotten out of hand. The history of money is a history of almost constant devaluations. So, back to Edward. This is a view that I used to fully support, but now I believe is only partially correct because economics is not a morality play. Now, I am agreeing with Edward, we are not forgetting. Yes, governments want to use inflation as a means of reducing the real burden of indebtedness. I usually point to the United Kingdom's post-World War II reduction in debt to GDP without default as the model. But the reality is that government deficits are the flip side of private and trade sector surpluses. Therefore, to the degree you do have a private debt problem, as we do today, you need private surpluses and government deficits to reduce the real burden without default or debt forgiveness. So you can't really posit this as a question of fiscal irresponsibility. Rather, it is a political question of who the winners and losers are in the workout phase of a private sector leveraging and deleveraging cycle. Now, I could read that again to you because I think that's very important, but I would hope that you'll read it yourself. And the words at the bottom are the beautiful deleveraging. Now we're moving on to the work of Ray Dalio, who I've quoted before, and Richard quoted yesterday, and he is going to be the basis of moving forward. But I urge you to read that last paragraph from Edward again. The Austrian, let's say, economic view is the simple view. It is easy to understand, and this is why so many people think they understand it. And it is what's going to get it could even become the prevailing view and probably get us into dreadful trouble, because the libertarian types, the Tea Party types, rich people and Germans aren't very good at subtlety. All they can grasp is the simple view, and the simple view simply is not enough. Subtlety is needed. And that's what we're going to move on to next via the thought of Ray Dalio. That's it for this presentation. Bye.